Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down the best Canadian REIT ETFs. These ETFs pay out a generous dividend and they allow you to tap into the Canadian real estate market with as little as $20. You don't need $100,000 as a down payment on a house. Instead, just buy a few shares of these ETFs and you'll collect reliable passive income every single month, and you'll gain a diverse exposure of the entire Canadian real estate market. I've already made several videos on ETFs and on REITs, but today we're going to combine them together. For this video, I'm going to assume you know what an ETF is, what an MER or management fee is, and you know the basics of dividends, DRIPs, and capital gains. If you need a refresher, check out my previous videos in my Millennial Investing Guide, especially my ETFs Explained, and then come back to this video. Basically, an ETF is a way to buy hundreds of stocks within one single fund. So instead of putting all your eggs in one basket by investing in one company, you're diversifying your portfolio by investing in a little piece of hundreds of companies all at once. A REIT is similar, but for real estate. A REIT is a real estate investment trust, and this is a large company that owns hundreds of properties and rents them out for a profit. So instead of putting all your money into one house, you can buy shares of a REIT, and then you'll own a little piece of hundreds of properties, and you collect your share of the rent every single month. A REIT ETF takes this diversification one step further. A REIT ETF contains dozens of REITs, each of which contain hundreds of properties. So with a REIT ETF, you'll be investing in thousands of properties across many different sectors, including retail properties, industrial, residential, and so on. That's the true power of REIT ETFs. You get instant diversification of the entire real estate market, all while earning great dividends every single month. For more info, check out my previous video, REITs Explained, to learn about the benefits of REITs and their investing strategy. So without further ado, let's jump into the best REIT ETFs in Canada. Up first, we have an old favorite, VRE by Vanguard. I've already talked about VRE in my video on the best dividend ETFs in Canada almost 2 years ago, and it's still one of my favorites. VRE tracks the largest REITs in Canada across many sectors, and as a capped ETF, it focuses heavily on the larger and more established REITs. This ETF contains the 15 largest REITs in Canada, most of which pay out a generous dividend. And so overall, VRE pays out a solid dividend yield of 2.81% paid out monthly. This dividend yield is definitely lower than usual since the share price has grown significantly as businesses open back up, but the dividend hasn't changed since last December, and so we can definitely expect a dividend increase very soon. Usually, VRE has a dividend yield above 4%. Vanguard is famous for offering the cheapest ETFs, and since this is passively managed, this has the lowest management fee on this list, with an MER of 0.38%. So if you have $1,000 invested in VRE, it will only cost you $3.80 a year in management fees. That's almost nothing, and a fraction of what you would pay for a mutual fund. Remember, with ETFs, you'll never see this management fee taken out as a transaction. This fee is built into the share price that you see. Another way to consider the effect of the management fee is to subtract it away from the dividend yield. So if our dividend yield is 2.81%, but we pay 0.38% in management fees, then our net income is 2.43% for the year. Of course, this doesn't include capital gains as the value of the ETF grows. This is just the income we obtain every year through dividends. Let's calculate the amount you need to qualify for a DRIP. Remember, a DRIP allows you to reinvest your dividend and use it to buy more shares of a company rather than receiving cash. And the best part is, you don't pay any commission fees at all when you use a DRIP to buy extra shares. This is the best way to invest in the long term, allowing your dividends to compound automatically, giving you true exponential growth. This is especially useful when investing in stocks, but if you're using QUESTRADE, which is my favorite online broker, you don't pay any commission fees anyway when you buy ETFs. So a DRIP won't actually save you any money, but it does automate the compounding growth of your ETF, rather than having to manually buy an extra share every single month. So if you'd like to sign up with QUESTRADE, click my referral link in the box below, and you'll receive $50 in commission-free trade rebates, plus I'll get a small referral bonus. So back to VRE. With a dividend yield of 2.81% and a share price of $37.82, you'll need $16,250 to qualify for a DRIP. Let's break it down. With $16,250 invested, that 2.81% dividend yield will give you about $456 a year in dividends, or about $38 a month. The share price of VRE is only $37.82, and so your dividend is enough to automatically buy an extra share, and you'll receive the remaining 20 cents as cash. I know $16,000 is a lot of money, but remember, you don't need to reach that drip threshold all at once. Invest what you can and slowly build up to it over the course of years. And you'll be earning great passive income and capital gains along the way. Check out my drip explained video to learn how to calculate the drip amount for any stock or ETF. So that covers the dividend and the MER, but we also want to consider the holdings of this ETF. This ETF contains 15 of the largest Canadian REITs, and it's well diversified across different sectors. The heaviest weight of 22% is on retail properties like shopping malls and outdoor shopping centers. Next, with 21%, is real estate services. These REITs don't actually own properties, they just manage them. And VRE is the only ETF on this list with exposure in the services sector. But note that real estate services barely pay a dividend. They're more focused on long-term capital growth. So these service REITs will bring down the overall dividend yield, but they offer more diversification. 18% of VRE is in residential, so homes and apartments. 17% is in office properties, 9% is the industrial sector, which includes warehouses and factories, and the rest is a diversified mix. Looking at the individual holdings, we have 15 REITs, but they aren't individually weighted. This ETF focuses on the largest REITs by market cap, so we can see that the largest REIT in Canada, Canadian Apartment Properties, a residential REIT, makes up 15%. Up next, we have First Service with 13%. This is a services REIT, so it barely pays a dividend, but it has excellent capital growth. Then you have the large retail, office, and industrial REITs like RioCan, Granite, Allied Properties, and H&R, each with a weight about 7 to 11%. I've talked about most of these REITs in my video on the best Canadian REITs, so check that out. The remaining 9 REITs in this fund all have a weight below 7%, with the bottom 4 being between 1 and 2%. You can see that this fund focuses heavily on the big players. In fact, the top 5 REITs alone make up more than 50% of the entire fund. If you want more exposure in the small cap REITs, the next ETF is for you. Looking at the share price over the last 5 years, you can see a very clear upward trend. As you can imagine, we saw a massive drop in the crash of March 2020, with offices and retailers being shut down. But it has recovered very quickly, and now it's back to all-time highs. And that's the power of real estate. There is a limited amount of land available, and so the demand always increases. And so with REITs and VRE, you can expect long-term capital appreciation, all while earning reliable income every single month. This is important. Whenever I'm talking about dividend yield in this video, I'm talking about the trailing 12 months, or TTM yield. So for VRE, it has a TTM yield of 2.81%. That means that if you add up all of its dividends over the past 12 months and then divide by the current share price, you get 2.81%. But many ETFs don't pay consistent dividends. They can change on a month-to-month basis, so it's important to use the TTM yield to give you an expectation of the entire year's dividends. The alternative is to use the forward yield, where you assume that the current month's dividend will continue for the rest of the year. But that might not be the case, so if the dividend changes month to month, the forward yield will swing up and down. In the case of VRE, its dividend hasn't changed since December of 2020, so using the forward yield or the TTM yield will be almost the same. But just to be safe, I recommend using the TTM yield. It's more reliable. Next up we have ZRE, the BMO Equal Weights REIT ETF. ZRE is a little different because instead of focusing on the largest REITs in Canada, they spread out their fund equally among 21 REITs. So the smaller REITs have just as much exposure as the large ones, giving you a truly diversified mix of the Canadian market. ZRE also pays out a higher dividend yield of 3.91% paid out monthly. With ZRE, the dividend has been consistent since February of 2020, and so in this case, the TTM yield and the forward yield are identical. But this ETF is a little more actively managed, and so it's more expensive with an MER of 0.61%. Those management fees are on the higher side, but the diverse portfolio makes up for it. And if you invest $1,000 with ZRE, it will cost you $6.10 a year in fees. Again, this fee is built into the share price, but I like to take it off of the dividend income. So with a dividend yield of 3.91% and an MER of 0.61%, we have an annual net income of 3.3%. And with a higher dividend yield, it's much easier to qualify for a DRIP. You'll need about $8,600 invested in ZRE. Let's check it out. With a yield of 3.91%, our $8,600 will give us $336 a year in dividends or $28 a month. The current share price is $27.68, so that's enough to get us an extra share every single month. Let's look at the holdings of ZRE. ZRE contains 21 REITs across all sectors of real estate. The heaviest sector is retail with 27%, followed by residential with 22%. Industrial is 18%, diversified REITs are 13%, and then we have office properties at 9%, and finally healthcare with 8%. You'll notice that this ETF doesn't contain any exposure to real estate services like VRE. Instead, this ETF focuses more on industrial and healthcare. Looking at individual holdings, we have 21 REITs and they're all equally balanced between 4 and 5% of the total fund. I'm not going to list all 21 REITs, but you can see that the top 2 holdings are 5.2% and the smallest holdings are about 4.5%, so they're almost equal. Compare this to VRE, where we saw a huge spread, with the largest holding being 50% and the smallest being just over 1%. In VRE, the big players like Canadian Apartments and RioCan were the largest holdings, but with ZRE, they're actually the smallest. This balanced approach gives extra exposure to the smaller and less established REITs, which have great potential for growth, but can be more volatile. Looking at the share price over the past 5 years, we see a very similar story with short-term volatility, but strong overall growth in the long run. We saw a massive drop in the crash of March of 2020, where real estate across the board was devastated. But with every drop, this ETF was able to recover very quickly. And if you were lucky to buy in at this discount, you would already be seeing huge capital gains, all while collecting that reliable passive income every month along the way. At number 3, we have XRE from BlackRock. XRE is similar to VRE since it's a capped ETF, so it focuses most heavily on the largest REITs in Canada, but it does have some exposure to small cap and mid cap REITs as well. XRE is the oldest REIT ETF in Canada. It's actually twice as old as the other 2 on this list. XRE is also the largest by far in terms of assets under management, so it's definitely the industry leader in the Canadian market. This ETF contains 19 REITs spread out across all sectors, and it currently pays out a dividend yield of 2.64% paid out monthly. This yield is lower than usual since the share price has grown so much over the past year, but it usually has a dividend yield above 4%. XRE is an example of an ETF which doesn't have the most consistent dividends. It can vary throughout the year. XRE's dividend was reduced in April and then increased in July, so for XRE, definitely use the TTM yield, not the forward yield. Since the dividend was recently increased, the forward yield is higher, but it's less meaningful. Just like ZRE, this ETF is on the more expensive side, with an MER of 0.61%. So if you invest $1,000 into XRE, you'd be paying $6.10 every year in fees. So with a TTM yield of 2.64% and an MER of 0.61%, you'll be getting an annual net income of 2.03%, plus long-term capital gains. To qualify for a DRIP with XRE, you'll need about $9,500 invested. Let's go through the math. With $9,500 invested and a yield of 2.64%, that gives us about $250 a year in dividends or $20.90 every month. With a share price of $20.64, that dividend is enough to get us a free share every single month. Let's check out the holdings of XRE, starting with the sector breakdown. This ETF contains 19 REITs spread across all sectors of the Canadian market, with 31% in retail, 25% residential, 20% in industrial, and then we have 11% in diversified properties, and then we have the rest in office properties and healthcare. The order of sector exposure is actually identical to ZRE, but the actual numbers are quite different, with XRE focusing even more in retail and residential and less on the healthcare space. And XRE has no exposure to real estate services, only VRE has that. Looking at the individual holdings, XRE has 19 REITs, and again, these are not distributed equally. XRE focuses on the largest REITs by market cap, so we see a very similar portfolio as VRE, with the largest by far being Canadian Apartments, RioCan, Granite, and Allied Properties. And just like VRE, there is a huge spread between the largest and smallest holdings. Canadian Apartments has a weight of 15% alone, but the smaller REITs only have about 1.5%. Again, the top 5 REITs alone make up 50% of the entire fund. The biggest difference from VRE is that XRE doesn't have service REITs. Remember, First Service alone made up 13% of VRE. And looking at the share price over the past 5 years, we see a very similar story to the other ETFs on this list, with very strong long-term growth. This ETF plummeted during the market crash of March of 2020, but XRE was able to recover very quickly. And over this past year, we've seen incredible capital gains, all while earning that generous monthly dividend along the way. For all these ETFs, make sure you hold them in your tax-sheltered accounts, like your TFSA and your RRSP, to avoid paying taxes on those monthly dividends and capital gains. And since these are REIT ETFs, their dividends are actually called distributions, and so they are taxed differently than regular dividends. So to make it easier, hold them in your tax-sheltered accounts. And check out my REITs Explained video to learn more about how REIT distributions are taxed in Canada. So there you have it, those are the best REIT ETFs in Canada. VRE has the lowest fees and is the only one to focus on REIT services. ZRE is the only ETF that is equally balanced, giving you exposure to the smaller Canadian REITs. And XRE is the oldest and largest ETF in this group, and its holdings and sector exposure are a bit of a mix of the other two. I personally own all three of these ETFs, and even though there's a bit of overlap between them, it's important to diversify and gain exposure of the entire Canadian market, rather than trying to pick the best one. If you'd like to see exactly which stocks and ETFs I'm invested in, and to help support my channel, hit the join button down below to gain access to my exclusive videos like my TFSA and RRSP portfolio reveal, and to see exactly which stocks I'm buying every 2 weeks. This membership program will cost you $5 a month, but please don't feel pressured to join. And don't just blindly copy what I do, but I hope that seeing my portfolio will offer some guidance, especially if you're just getting started. And to actually buy these ETFs, I recommend QUESTRADE, which is my favorite online broker, since they don't charge you any commission fees at all when you buy ETFs. To get started with QUESTRADE, click my referral link in the box below and you'll get $50 in commission-free trade rebates for the first 30 days when you sign up. That basically means that your first 10 stock trades will be commission-free. That saves you $50, plus I'll get a small referral bonus as well. So thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel, and hit that bell icon to be notified of my new videos. And if you'd like to follow me on Instagram or Facebook at Canadian T-shirt, click the link in the box below or click the links on my homepage. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.